Okay, good morning. Are there a lot of people online? It seems like kind of thin here. Oh, that's good. Okay. Good morning. Today we're going to finish up Chapter 8. And I don't want to demotivate anyone, but I would say even I find this a bit boring. So just, so I apologize in advance, right? Okay. So as we get ready to jump in here, couple of administrative things. First, we have a question out there, and we have 215 responses, and everyone is correct. I should close it just. We've never had one with everyone right. Woo! Wow, 224, 100% right. Oh. Well, close. Okay. So we'll leave it open for a minute. Okay, so practice exam 2 counts as a quiz. It is due before 4 p.m. Wednesday. You have to take it before you take the exam. We're going to talk a little bit about administrative details. The Chapter 4 and 8 homework is due this weekend. It is one assignment, and I sent out step-by-step videos yesterday for each of the homework exercises. We're not going to get to them all today. We're going to do part of one, so it is there. There is a black box on the screen, and I can't figure out how to get it off today. I'll figure it out by Monday, but it should not interfere with anything. There is no class next week because your job next week is to take the exam. So, no class next week. The next time we have class will be the following Monday. The exam is over Chapters 4 through 8, and we have only one learning objective in Chapter 4. I think it was learning objective 3. It was the bank reconciliation, and then in Chapters 8, it's 1, 2, and 6. We'll see that coming up. Okay, so the exam, you have to start it by 4 p.m. Wednesday, November 4th. It will become available Monday morning, and if you're in Section 7 or 8, just remember you have to schedule soon. You get the better selection of time. On the exam, now just to say a few words about the exam. The exam is very similar in format to Exam 1 in that it is the same number of multiple choice questions, approximately the same number of homework problems. This exam, on average, takes people 10 or 15 minutes longer to finish just because the material is more lengthy, more complicated. This exam, not to scare anyone, but this one is typically the lowest score of the 3 exams. This is kind of tough stuff, and I know that, and inventory, you have to practice it to be able to do it. Today we've got some stuff on investments, and that takes some practice as well. So the practice exam is similar to the first one in that it reflects stuff that really could be on your exam. You have a maximum of 5 attempts. I would personally do all 5 attempts because it's going to be different each time you take it. You want to work through it, but you also want to make sure the last few times you take it that you're not using the help me solve this and things like that. You're not relying on those. For the exam, you will be provided 1 sheet of notes. In the computer lab here, they have them, and you'll have 1 sheet of notes. That link is on Blackboard. You can see what's on it, but for example, the bank reconciliation form is on it with abbreviations, but it's on it. The debit credit rules are on it, and there's a few inventory rules on it. So there's some help on that sheet. If you're in Section 7 or 8, you get to use the sheet as well. You have to use it in PDF form, and ProctorU will give it to you. I have been on the phone with them a couple times to make sure they've told all their proctors this. But if you're in Section 7 or 8, you are entitled to that PDF. Don't take it without it. If the proctor would say to you, no, there's no sheet, don't go quietly here. Say, yes, there is, and have them check, because it definitely is there. I've talked to ProctorU because we had an incident with the first exam. Okay, because I did that last week. So just make sure that we had an incident with the first exam. What I was going to say is someone was told they weren't allowed to use the note sheet, and that's not true, and I apologize in advance if that particular proctor isn't aware of that, but I've taken lots of steps, crazy steps, to make sure. So don't take it. I mean, have them, at the worst case, have them contact me, but it's in their system. I've seen the instructions. You do get the sheet. Okay, so Chapter 8, long-term investments. Again, not an exciting day today. I apologize. It is one of those things. It's like you have to eat your vegetables. I like vegetables, but this is like our vegetable chapter. Okay. So learning objectives 1, 2, and 6. We're going to start by talking about, so on Monday we talked about investments. This is an investments chapter. This is long-term investments. We had a lot of this in an earlier chapter where we talked about short-term investments. Now we're talking about long-term investments. These are called available, if management intends to hold them for a while, like more than a year, but is going to sell them before the maturity date, they're classified as available for sale investments. These might be debt securities, like we buy a bond in another company. We buy a Solar City bond. That's an investment for us. If it's a 2-year bond and we're going to hold it, for a year and a half, that could be one of these. Or equity securities. Equity securities are stock in another company. So debt securities are bonds that we bought. Equity securities are stock we're buying in another company. We initially record these at cost. So whatever we pay for them is what we record them at. And then they get adjusted to fair value or current market value. Okay, so if you have the notes downloaded from PowerPoint, the PowerPoint downloaded from Blackboard, that's great. You have a lot more detail. I would highly encourage you to do that. But we're going to skip around some, so you may have to look, skip a few slides, and we're not going over every slide here. Okay, I'm going to close this question in about 5 seconds, so make sure. Okay, so investments, we have stocks. We have an investor with stock and an investee. So the investor is the one that owns the stock of a corporation. The investee is the entity that issues stock. Bonds, where we're buying bonds in a company, the bonds, the entity that issued the bonds is known as the debtor. Okay, so stocks, when we have stocks, we have the investor. This is the one that owns the stocks or bonds. We have the investee, the company that issues the stock. By the way, if we buy stock in another company, it's listed as an investment. If we own stock in another company, it's an investment. Whenever you see the words common stock, that refers to our own stock that we've issued. So if we buy stock in another company, it's an investment. It is not common stock. Common stock means it is the stock that we've issued. Okay, on the balance sheet. On the balance sheet, we have what we're doing in this chapter is we're doing long-term investments, okay, and they're down below current assets. So the short-term investments are in current assets. Long-term investments mean that we're going to have them for more than a year, okay, and it's based So if we're going to have them for more than a year, it's a long-term investment. Put the session ID in the chat room because now it's not on my slides. Thank you. Okay, this is not a question. Even though it says question, it's not. Okay, this is a kind of guess in your own mind type question. Which of the following product groups represents the highest dollar value in U.S. exports? So basically, what dollar value does the U.S. export the most of? So you have a choice of vehicles, electronic equipment, machines, engines, pumps, aircraft, spacecraft, or oil. So you have those 5 choices. So just mentally lock in an answer. This is not a question in learning catalytics. It's just meant to be kind of like one of those trivia things. Like, I would not have gotten this right. So out of all those things, what does the U.S. export the most of in terms of dollar value? Again, not a question. Okay? Yeah. Okay, so it's actually machines, engines, and pumps. Okay? And when you look at if you rank those in order, this is machines, engines, and pumps are the largest export in dollar value, then electronic equipment, third is oil, vehicles, and then aircraft. So we have those categories. And the reason I'm getting to this for a reason, because I'm going to show you a balance sheet here. So machines, engines, and pumps is our #1 export. Who knew? Okay. Now, another question that's not a question is what company exports the highest dollar value? Okay, so what company, instead of what product category, what company exports the highest dollar value? So, what? I'm sorry, I didn't hear, but I'll just, okay. Boeing Airlines exports more than any other company in the U.S. So the reason I did that is because we're going to look at Boeing's balance sheet. These investments show up in this chapter, show up in the balance sheet. We had an earlier chapter, we had investments, short-term investments. They show up earlier up top on the balance sheet, and then the ones we're doing in this chapter show up down below in the longer-term assets. So we have current assets. Those are things that we're going to have less than a year. Then we have long-term investments, which are things that we're going to hold more than a year. So those 2 categories combined for Boeing are almost $7.4 billion. So there's a lot of money in investments. Okay, and then when you go to the notes in the financial statement, you know how we said that the notes, you can't just look at a financial statement, you have to look at the notes. So if we were interested in Boeing looking at their investments, if we went to the notes, we would see that they took the short-term investments, the long-term investments, and in the notes combined, told us what kind of investments they have. So when we look at a corporation's balance sheet and it says investment, what's in there? Time deposits. Those are CDs. They go to the bank and get a certificate of deposit or another similar instrument. Pledged money market funds. Available for sale investments, exactly what we're talking about in this chapter. Equity method investments. Again, if you're an accounting major, you're going to hear about equity methods later on in a future class, not in our class, and some other investments. So investments are what the focus of this chapter is, specifically those longer-term investments. So now we're going to do an example of a company buying an investment. So we're going to start right now with buying stock. So we have Intel purchasing Hewlett-Packard stock. So Intel purchases 1,000 shares of Hewlett-Packard common stock at the market price of $44 a share. So we are doing this from the standpoint of Intel. So Intel, it plans to hold this investment for longer than a year, Okay, so its intent, management's intent to hold more than a year and treats it as a long-term available for sale security. The AFSS acronym, but you don't have to memorize it. We'll see if you have any questions on your exam, they will always spell out available for sale security. Okay, so our entry to record the investment, first of all, we're going to have investment as our asset. So we have investment, and the amount of the investment is 1,000 shares times $44 a share, so $44,000. We'll have cash credit of $44,000, and that's what we do to purchase the investment. We have 3 or 4 journal entries we need to be able to make in this chapter, and this is one of them. We're going to have the investment, the purchase of our investment. We're going to record it at our cost. Okay, so that's one journal entry we need to make. Now note that we paid $44,000 for this, because that'll come up in just a minute. So the $44,000, hold that off to the side. Now assume that we get a cash dividend, and our cash dividend is going to be 20 cents per share. So 20 cents per share, if we look back, we bought 1,000 shares. So 20 cents a share is going to be $200. Okay. So cash will be 1,000 times 20 cents. There's a decimal place missing here. 1,000 times 20 cents per share is $200. So we're getting cash and we're crediting dividend revenue. Okay? So you have to be able to record the investment and record the dividend revenue. Okay, I just have to tell you, this has never happened ever. I've been using Learning Catalytics for 2 years now, and never have I had every single person in class answer the question and every single person answer it right. So it must be a good day, right? So we had 362 people answer it right. So good job. So, wow. Yeah, just a little piece of trivia there. So, cash dividend. Next up, now, so we buy the security, we buy it, we record it at cost, we get dividends on it. Next up, we have the, we have to adjust it. This is one of the few categories of things on our balance sheet that we actually adjust to the fair market value. Everything else is carried at historical cost. If we buy a building, we're going to carry it at cost. We're not going to adjust it. If we have inventory, we carry it at cost. Investments are different. We're going to adjust those to market value. And this is market value, fair value, current value. They all kind of mean the same thing. So now we have to record these at fair value as of the balance sheet date. Okay, now the carrying value of our investment is going to be the original cost of the investment plus the allowance to adjust if the fair value is greater than the cost. What does that mean, fair value greater than cost? That simply means we pay the current market value is more than what we paid for it. Okay, or we subtract the allowance if it's worth less than what we paid for it. Basically, we want to value it on our balance sheet at what it's worth. So we're going to see examples of that. But fair value over greater than cost, that's not an equation as much as, well, gee, if it's worth more than what we paid for it, it's going to increase the value on the balance sheet. If it's worth less than what we paid for it, then it's going to decrease the value on the balance sheet. Okay, so now let's do an example of valuing this. So at the balance sheet date, we need to adjust our investments to fair value, to current value, fair market value. And so what we're going to do is, remember we bought the stock, Intel bought the stock for $44,000. So it bought it, that was a couple slides ago, we bought it for $44,000. Now assume that at the end of the year, the quoted market price of the stock is $46.50 a share, making all 1,000 shares worth $46,500. Well, great. We went from $44,000 we bought it for, now it's $46,500. So what we're going to do is we're going to debit our allowance because we're increasing the value of the investment. And the amount that we're doing is the $46,500, which is what it's worth now, minus the $44,000, which was our original cost that came from a couple slides ago. Okay, so then we're going to credit this account called unrealized. As a reminder, this word unrealized, this is going back, we talked about it in an earlier chapter. This word unrealized means we're still holding it. If you ever see unrealized, it means the company has not sold it yet. It's still holding it, and that's a signal that this hasn't actually changed hands, that they don't actually have this money, but they're revaluing it. The reason we revalue securities is because there's a readily identifiable market value. We have a stock, we can look at the stock market quote. Why wouldn't we want to revalue these things? So that's why investments are a little bit different than other assets. Okay, so we're going to have the difference between what it's worth now and what we bought it at. That's our unrealized gain. Gains are always credited because gains are like revenue, treated like revenue. If this were worth less than what we paid for it, we're going to have an unrealized loss, and that'll be debited. Okay. Now, this kind of says the same thing as 2 slides ago. If our fair value goes down, meaning that things are worth less than what we paid for them, we're going to debit the unrealized loss. And if the fair value increases, meaning it's worth more than what we paid, then we will credit unrealized gains on investment. And this is part of what I don't like about this chapter. And if I were doing this chapter myself, writing it, I would get rid of this. But this is where it's a little bit beyond what we're doing here. If you're an accounting major, you're going to go way more in depth than this. But we have something called other comprehensive income. When we have this unrealized gain or loss, it doesn't go on our income statement. It doesn't, because it's not real yet. That's why it's called unrealized. So it goes under other comprehensive income. That's all you need to know. It's not on the income statement. It goes under other comprehensive income. And we're going to finish up our Intel example on the next slide here. Okay, so let's say that Intel sells its entire investment for $43,000. So what they're going to do is they're going to get rid of that unrealized gain. You know what? We're not doing the slides. You will not have to do a sale. That's way beyond, so we'll get rid of this. Okay, so you're not doing a sale. Let's go on to short exercise 8.1. Okay, short exercise 8.1 gives us an opportunity to use a couple of the journal entries. So what we have is we have 3 transactions, and we have to write the journal entries for them. So the first one is April 10th, we purchased 600 shares of stock, paying $17 a share. Okay, 600 shares of stock. That's going to be $600 times $17 a share. So we're making the investment for $10,200. So we're going to debit the investment, credit cash. So we record them at cost. Okay, so far that should be pretty straightforward. We have an asset called investment now, and we're going to credit cash. Okay. Next transaction down is July 22nd. We received a cash dividend of $1.24 a share. So what's happening here is the company is paying, we have 600 shares. So 600 shares times $1.24 per share, what we're doing is we're getting cash for the $744, which is the 600 shares times $1.24 a share, credit dividend revenue for that dividend revenue we're receiving. Again, this is an investment, so we're getting all this. We're not paying it. Okay, third transaction now. Third transaction says adjusted the Bison investment to its current market value of $5,500. So when we adjust the investment to its current market value, what we first have to do is figure out, we paid $10,200 for this. So we paid $10,200. We have a current value of $5,500. So we have an unrealized loss of $4,700. Why is it an unrealized loss? Unrealized means we haven't sold it yet. We have not sold it. We still own it. We need to mark it down to market. It has fallen in value. Okay. So what we're going to do then with that is we're going to debit our loss. We're going to debit unrealized loss on available for sale securities, and we're going to credit the allowance to adjust investments, okay? And we're crediting it there because it is a loss. So those are the three journal entries. You need to know how to do all three of those journal entries. Those are pretty basic journal entries. Next, it says, assume that this stock is Tiffany Company's only investment. How will these transactions be reflected on the income statement? So how the income statement will have dividend revenue of $744, and then the second part, we have a statement of other comprehensive income. That's where the unrealized loss is. Again, you're not going to do a statement of other comprehensive income. You just need to know it doesn't go on the income statement. Okay, now the last question on this says, how should we report any investment in unrealized gain or loss on the balance sheet? So how we're going to do that on the balance sheet, again, that is, the box is covering the number, and the number is 5,500. Is that it? 5,500. So 5,500, and so the long-term investments are going to be for the current market value of the security, 5,500, and then stockholders' equity will have the unrealized loss on it. And I want to point out that if you're doing the homework and you have an unrealized loss, make sure, you're really doing a bad job there, make sure that you put the parentheses around loss. If you see loss, it needs parentheses around it. It is not the same. If you put in $4,700, it'll be wrong. Well, it'll probably be wrong because you'll have different numbers. But if you have an unrealized loss and you don't put the parentheses around it, it's wrong. You need to make sure if you have a loss that you put parentheses around it. If you're looking at an income statement ever, it makes a difference. If you look at the bottom line, if there's parentheses around it, that's a big deal. It means they have a loss. So the parentheses are major, and so losses have to have the parentheses around them. Okay, I'm going to send out our second question. Okay, our second question. Unrealized gains and losses from available for sale investments arise from what? Okay, key word here is, when you're doing this one, the key word is going to be unrealized. Okay, so think about what unrealized means. Unrealized gains and losses only occur because of one thing, from doing one thing. Okay, unrealized. Got to get your answer in here. I'm waiting for people to get rung in. So about another 10 seconds, got to get your answer in. Okay, as we wait for these to go in, let me talk about, so unrealized. What the word unrealized means is you still hold it. You're still holding it. And unrealized comes into play only because you've hit the end of a period, financial statement period, and you have to adjust it to market. That's the only thing that will give rise to unrealized gains and losses. So looking through here, purchase of an investment, you don't have unrealized gains or losses. If you purchase something, you don't have a gain or loss on it. You simply made the purchase. So it can't be A. Okay. Sale of investment. If you sold the investment, you have a realized gain or loss, or you have a gain or loss. We don't always put the word realized in it. In fact, we never put the word realized. So if you see the words gain or loss and there's no unrealized in front, they actually sold it. So it can't be B. And D, management's decision. Management has no decision to make. Generally accepted accounting principles say you must adjust to market at every financial statement period date. So you have to adjust. There is no management decision involved at all. So it can't be D either. So we're left with C. I'm going to close this in 10 seconds. So unrealized gains and losses come from changes in the market value of securities we're still holding. Realized gains and losses, or gains and losses, come from the sale of the investment. Okay, so now we're switching over to debt securities. Debt securities in this chapter, we're dealing, again, just a reminder, we're dealing with the investor, the one that buys the bonds, okay? So in this chapter, we have an investment in bonds, which is an asset, and we have interest revenue. In Chapter 9, when we come back after the exam, Chapter 9, we're going to be talking about the issuer of the bond, the one that actually issues the bond when they, so they're issuing the bond, they're borrowing the money, so they have interest expense. Okay, now we're going to go through a quick example. This is Intel Capital. Let's say now Intel buys a bond. So Intel buys a bond. In this bond, the first thing it says, we have to interpret this first statement. It purchases $10,000 of 6% bonds. So we have this purchase $10,000, okay? So we purchased $10,000 of bonds. That's known as the face value, the par value. It's got a couple different terms. But that's the face value, the par value, it's principal, if we think of it that way. Okay, so that's how much CBS Bonds is going to pay Intel at the end of the bond. That's how much CBS is borrowing. So the $10,000 is the face or par value. The next term over, the 6%, that is the annual interest rate that this bond pays. So this bond pays 6% per year. That interest rate will always be expressed on an annual basis. Now, the 6% is going to be of the face value. Okay, so the 6%, it's going to pay 6% of $10,000 each year. Okay, that doesn't change. Now, at a price of, okay, prices are always stated at a percent of par value. So they sold this bond for 95.2% of $10,000, and we'll see that on the next slide. Now, why did they sell it for less? Market rate, in this case, the market rate of interest is something above 6%. We don't know what it is. We'll see more of that again in Chapter 9 when we talk about the issuing bonds. But we have bond prices just like we have stock prices. And bond prices are a function of what the bond pays versus the market rate, and then you throw in some risk, like is this a risky bond or is this a real stable company issuing the bond? But so we'll just leave it for right now that these bonds were sold and the market rate is something higher than 6%. So this company has to say, ooh, my bond's on sale, is kind of what they're saying, is I'm going to sell it at a discount because I know my bond doesn't pay as much as these other bonds, but I want you to buy mine, so I'll give you a discount. So Intel Capital is only going to pay 95.2%. That price could be 101.2. It could be 100. 100 would be par value, but it could be 99.5. It could be 97.5. It could be 103%. So it's going to be clustered something around whatever percent of face value that this bond is. Now it tells us that we intend to hold their bonds till their maturity date. It tells us the maturity date is 2018. So this is a 4-year bond. These are 4-year bonds because we're purchasing them in 2014. They mature 4 years from now. Interest dates are semi-annual. So this bond pays interest twice a year. Now, interest rates on bonds are always quoted at an annual rate, but they typically pay twice a year. So you get half the interest twice a year. So you'll get, in this case, they're going to get 3% on April 1st and 3% on October 1st. So the interest rate is quoted on an annual basis, but if it's paid semi-annual, you get half each period. The bonds mature on April 1st. They'll be outstanding for 4 years, which is 48 months, just taking 4 years times 12 months. So those are the facts of the case. We're going to refer to these as we do the journal entries for this example. Okay, so the first thing we're going to do is record the purchase of this bond. The purchase of the bond, our bond issue price. That's where we're going to take the face value, 10,000, times the 0.952 or the 95.2%, and we get 9,520. That's how much they purchased the bonds for. The bonds are carried at cost, 9,520, and we're going to credit cash. And so this is the entry to record. So it's very much like the last investment we did. We're going to debit the investment. We're going to credit cash. Okay, now that's entry 1. We have a couple more entries we have to do here. And the next one, we're going to receive interest. We purchased these April 1st. These bonds pay interest April 1st and October 1st. We're not going to get interest the day we purchase it. We're going to get our first interest in October. So in October, what we're going to do is we have the receipt of interest. So we're getting cash. We're taking 10,000 times 6% times 1/2 or 6 months out of 12 because this is the 6 months. We get interest every 6 months. So we're getting half the interest on October 1st. We'll get the other half on April 1st. And our credit is interest revenue. So that's it. We record the receipt of interest, debiting cash, crediting interest revenue. Now, the next one we have to think about. So I said that we purchased these bonds for $9,520. So that's our purchase price. We paid that. At the end of the 4 years, we're going to get $10,000. So we got a discount on these bonds. The difference between $10,000 and $9,520 is our discount. And what that represents is, in effect, extra interest that the company's paying us, because this bond is paying 6% interest. Maybe the market rate of interest is 7%. We don't know what it is. but it's something higher. That's why companies sell bonds at a discount, is their bond doesn't pay as much interest as the market. So they sell it at a discount. So this discount represents extra interest in effect, but we'll get it at the end. So what we have to do is every period we need to recognize that we have to amortize that discount. We need to spread that discount over 48 months. So what we're going to do is down at the bottom of the screen here, I've taken the $10,000, which is the original cost of the bond, okay, or the original face value of the bond, and subtracted what we paid for it, okay? Then I'm going to divide that by 48 months. 48 months, this is a 4-year bond, 12 months a year. So 48-month bond, so I'm figuring out how much interest I have to recognize every month, and then we had 6 months that we've held it. From April 1st to October 1st, it's been 6 months, so I'm going to amortize this bond, and what I'm doing is I'm recognizing additional interest revenue on this bond, and the bond investment itself is going to go up for the amount of the interest revenue I'm recognizing. We're going to credit interest revenue, and that process is called amortize. We're going to talk more about that in a later chapter, and this is just on the boundaries of what I think is beyond what we're doing here. So, but we need to know that if we do purchase a bond, chances are we'll pay more or less than the par value, and the difference represents either a discount or premium, and we'll talk more about premiums next chapter too. Okay. So we're going to not do the year-end adjustment entries here. Okay. So things to know. These are held-to-maturity debt securities. So this is a bond I bought. I have the intent to hold it until it matures. Interest is typically received semi-annually. It's quoted when you see the percentage, the interest rate on it, that's an annual rate. Typically they have interest twice a year. And the price is quoted as a percent of par. If the price is greater than face rate, if the market rate is greater than the face rate, so the market rate is 7%, our bond pays 6%, we have to sell at a discount or buy at a discount. If the market rate is less than the face rate, maybe our bond's paying 8% and the market is 6%, we can sell it for more than its face value. So it all balances out over time. So we have a discount and a premium. Okay, so we're going to do a quick question. Now this question is not hard, it just looks long. But I want to say the abbreviations in the answers. ST, I was abbreviating short term, okay, or current asset. Short-term investment. LT is long-term investment. So what we have here, January 1st, Plymouth Company purchases $100,000 6% bonds at a price of 90.4 and a maturity date of January 1st, 2016. So look at this. We're purchasing 2012. These bonds mature in 2016. Assume that they're going to hold them to maturity. Okay? So Plymouth interest is paid twice a year. They have a calendar year end. It's talking about the entry to record the purchase of the bond investment. So when we initially purchase the bond investment, what are we going to do here? And I just sent this question out. So again, ST is short-term, LT is long-term. Okay, so you need to get your answer in here. We're waiting for about 100 people. Again, short-term investment, ST stands for short term. That's something that's a year or less. Long term is something that's more than a year. LT is long term. Get your answer in so you're not locked out. When you're looking at this, first of all, we bought this bond on January 1st, 2012. It matures 4 years later, okay? For something to qualify as a short-term investment, it has to be less than a year. We're not told they're going to sell it in under a year, so we have to assume it's long-term. So when you're answering this question, it absolutely, positively cannot be answers A or B, because it's not short-term. It's 4 years, which is long-term. So it has to be C or D, okay? Okay, if you're going to change your answer, you're going to have to do it pretty quick, okay? So it can't be A or B. Now, in terms of whether it's C or D, so the only difference between C or D is the amount. It says that the face value of the bond is $100,000. We don't record it at face value. We record it at the cost. The cost of the bond is the price times the face value. So I don't have to do any math. All I have to look at is a price of 90.4, so it's not 100%. It's going to be 90.4% of the face value. It cannot be 100,000, okay? So it cannot be answer C either. So closing this question, good. We've made a lot of adjustments here, so that's good. Closing this question about 10 seconds, so if you're going to change your answer, change it now. Okay, so again, it's going to be that long-term investment. Okay, so now we're on to the last learning objective for the chapter. The last learning objective for the chapter is the principal amount, time value of money. Time value of money. We're dealing with investments that have a very long time frame. And if I'm dealing with an investment that is going to mature 5 years from now, that $100,000 I'm getting 5 years from now is not worth $100,000 right now. It's worth less than that. And that process to figure out what something's worth today is called discounting. It's calculating the present value. We have a future value, which is what we're going to get sometime in the future. We have the present value. What's it worth right now? And the principal is the amount borrowed or invested. Now we're going to do some really basic time value of money calculations in here. To do those calculations, we're going to use two tables in the book. For all the homework problems or test problems that refer to these tables, you will be given buttons that you can click on the button and get the table. So you don't need a paper table. It will always be available to you. We're using the tables. You can also, as an aside, you could use a financial calculator, but you're not allowed to use a financial calculator on the exam, so that eliminates that. Plus, I'm not going to require a financial calculator for one chapter. That would be silly. And Excel is another way to do it, but again, you're not going to be using Excel on the exam. So the tables are the easiest common denominator, so we're going to go through how to use the tables. So there's two tables. There's actually 4 tables in your book. There'll be 4 buttons that you have a choice of. We're going to eliminate 2 buttons right off the bat. You will not use any button for future value. So if it starts with FV, F as in future, you don't need it. So you don't need to click on the future value button. So you can eliminate those 2. We're going to deal with 2 tables. The first table, if you have the physical book, is page 487. It's called the present value of the dollar table. Okay, it looks like this, so we're going to go through in a few minutes how to use it. So present value of the dollar table is one of them, and the present value of an annuity table is the other. So those are the 2, and present value is often abbreviated as PV. So that's the other one. These are the 2 tables you'll be using, and we're going to talk about how to get which table to use. Okay, so which table do you use? The present value of a dollar table, that PV of a $1, single dollar, that's if we have a single payment. So let's say we're going to get $100,000 5 years from now. That's one sum of money. So that one sum of money, we use the present value of a dollar table, okay? The present value of an annuity table, it'll say present value of an annuity of $1 or something, but the word annuity will be in it. You'll see present value and you'll see annuity. We use that table when we have two or more equal payments. And payments don't mean they can mean payments we're making or payments we're receiving. But so let's say you're going to get $500 every month or every year for the next 10 years. That's an annuity because it's every year. So if you see this much per year or this much a year, this much every year or annually, those are referring to annuities. Okay, so we have a region question coming up. Just as a reminder, you'll touch your screen to answer, and so you'll touch it whichever table, and then click Submit Response. Don't forget to submit your response. You can't receive credit if you don't submit your response. So the question we have is, you don't have to do any math on this one. You're simply going to say, okay, you'll receive $1,000 3 years from now. So you're going to receive $1,000 3 years from now. Which table do you use to calculate the present value? We're not doing that. You're getting $1,000 3 years from now. So which table? The top table is present value of a dollar table. The second table is present value of an annuity table. Again, I'm going to go back to this slide telling you which table to use. We've got the present value of a dollar table, which is for a single sum of money, one single amount, or the present value of an annuity table, which is when we have a series of equal amounts over and over. Okay, again, when you're looking at this, okay, now you have a question. Pardon me? Okay. Okay, I'm going to be leaving this question soon, so you need to make sure you have the dot on it, or you can put a little X on it, or so you can see it better, but you have to touch somewhere in the table that represents the one you would use for a single payment or a single sum of money. Okay, make sure you submit it. I'm going to be closing this in 10 seconds. So you need to select your table and hit submit. Right now we're shy some students. Make sure, I don't want to sound like a broken record. I'm watching this, we're just getting a lot of slow responses. So make sure, not slow, as in turn, I'm still waiting for a chunk of people. Make sure once you select the dot, you have to press submit your answer. It's not going to count it if you don't do submit your answer. Your screen you should get that normal screen about your answer has been submitted. Okay, so that was present value of the dollar table because we had one sum of money. We're going to receive $1,000 3 years from now. Okay, so let's try another one. This other one, the next one is you will receive $1,000 a year every year for 4 years. So you're getting $1,000 this year, $1,000 next year, $1,000 the next year, and $1,000 the next year. Which table do you use to calculate the present value of those payments? Okay. Again, you want to make sure that you kind of aim. I mean, there's a lot of leeway. There's one person that has their answer on the very, very, very border. It's going to be, I mean, I think it's below it from what I can see. So you want to make sure, to be safe, just kind of aim anywhere in the table, but don't aim for one of the lines, because that's if you put your dot anywhere down along a line on a row that says 5, if you did the line, you might want to resubmit it, because I do see some people right on the border. Don't hit the border. Whichever answer you're answering, don't hit the border. Because I'm not asking you which number, I'm just asking you which table. Okay, I'm going to close this in 10 seconds. Be sure to submit your answer. Okay, and that answer is the present value of the annuity table. Okay, so now we're going to go through how to use the tables. So next step up is we're going to do short exercise 8-9. So we're going to calculate the present value. So now we're going to pick which table, and then we're going to use the factor in the table. So the first one is $10,000 at the end of 5 years at 8%. What it's asking is, what is this worth right now if somebody says, I'm going to give you $10,000 at the end of 5 years and pay you you could earn 8% in the meantime. These come into play when companies have insurance policies or companies buy investments. We want to figure out what it's worth right now, because if I had $10,000 right now, I could earn 8% on it. It's certainly going to be worth a whole lot more than the $10,000 they're giving me 5 years from now. Another way to look at this is, what would I have to put in the bank right now to have $10,000 at the end of 5 years if I was able to earn 8% on my money? So first thing you have to do is ask yourself, which table? So which table do we use? We're getting $10,000 one time at the end of 5 years. So that is going to be the present value of a dollar. That's one time, one single sum, so we're going to use the present value of a dollar table. Okay? So then what we'll do with that is we have to find the factor. So we have to locate the column with the interest rate on it. We use the interest rate we're given, the 8%, so we find the 8% column, and then we find the number of years. We're just going to do full years, full interest rates at this point. So 5 years, the fifth row, the 8% column gives us a factor of 0.681. So we have our factor. What do we do with it? Well, we're going to take our $10,000 times the 0.681, and we'll get $6,810. So that means if I put $6,810 in some instrument today and was able to earn 8% for 5 years, I would have $10,000 at the end of 5 years. Okay, so that would be the how to use to do part 1. Part 2 is $10,000 a year at the end of the next 5 years at 8%. So what we're going to do there, first question is which table to use. Which table to use? This is $10,000 a year. That means we're getting $10,000 every year. So we're going to take 2 or more payments. So we're going to use the present value of an annuity table. So what we're going to do next is we pop up the table, and now we have to find the factor. It's 5 years, so we go to the fifth row, 8% column, and we get a factor of 3.993. Okay, so we're going to take $10,000 times the 3.993, and we get $39,993. Do you have that one? $39,930 is what's covered by the box. $39,930. Okay, so those are two very basic introductions to this. What we're going to do is we're going to do another question here. And now on the question, before I put it out, let me put it on the screen first. Well, okay, I'm not going to, I'll do this one, that's fine. Okay, you will receive $1,000 3 years from now. The investment pays 6%. Okay, so you're going to get $1,000 3 years from now. The investment pays 6%. Which factor you'll use? I've given you the table. I've told you this is a one sum of money. So you use the present value of the dollar table. That's what the table is showing here. And now what you need to do, and this is where you need to be careful, you need to tap on the actual factor. I've given you the table, so you need to do, okay. So you need to identify the factor that you would use. So you can tap on it, put a little check mark on it, but you'll need to be fairly precise here. Okay. And again, you're not identifying the column heading. If you did the 6%, it's not right. You have to find the factor in the table that you would use. Again, let me show you. We're not asking for the answer. Okay. We're not asking for you to tap these numbers across here. Okay? We're looking for more than your column. You identify the column. I'm also not asking you to tap over here on the periods. What you're trying to do is identify the factor that you would use, and you need to tap on one of the numbers in the table, not the row headings. Yeah, this will be the factor. I'm not asking you to multiply yet or anything like that. We're just identifying the factor for this investment. I'm going to be closing this in about 10 seconds. So again, identify the factor. Last chance. Okay, so your correct answer is going to be that 0.840, okay? And that's the factor. What you do with that factor then is you would take the 0.840 times 1,000, and that would give you the present value of this investment. So that's what we're doing with it. That's why we're identifying the factor. So you take the factor, multiply by the 1,000, that will give you the present value of this $1,000. Okay, that brings me to the end of what we're doing today. I will, if you have questions as we go, certainly send them to me. Remember, we do not have class next week because of the exam. And have a nice weekend.